Welcome again, dear students and scholars. In the previous video, we built the scope map for ASC 310. Now the accounting begins. Once we know that a receivable is inside the topic, we have to answer four practical questions. When does the asset enter the books? At what amount is it first recorded? How does that amount change over time? And is management holding the receivable or preparing to sell it? This is where a receivable stops being only a label and starts becoming a measured financial asset under US GAAP. A receivable may be the same legal claim, but the accounting questions can be very different. If the claim came from a cash exchange, measurement is usually more direct. If it came from goods, services, or property, present value becomes more important. If the stated interest rate does not reflect market terms, ASC 835 enters the discussion. And if management intends to sell the receivable, the measurement model changes. Good accounting here is basically a sequence of gates. Skip one gate and the carrying amount can go in the wrong direction. Here is the learning path for this video. First, we recognize the receivable by confirming the right to collect cash. Second, we identify the exchange that created it. Third, we measure present value using either cash proceeds or discounted cash flow logic. Fourth, we handle fees and rebates that affect timing of income. Fifth, we classify the asset based on management intent. And sixth, we hand off to related guidance when needed. By the end, you should have the measurement foundation ready before we move into ASC 310-20. Recognition starts with a real right to receive cash. The form can differ: credit sales, cash advances, formal notes, or lending arrangements, but the threshold is the same. The entity must have an enforceable and measurable right. A customer owing money after revenue is earned creates one kind of receivable. A borrower receiving cash today creates another. A signed note gives formal documentation. A lending arrangement gives structured repayment terms. The accounting does not begin with optimism. It begins when the claim exists and belongs on the balance sheet. When a note is received solely in exchange for cash, the starting measurement is straightforward. The present value at issuance equals the cash proceeds exchanged. In simple terms, the lender paid cash today and received a note in return, so the cash exchanged anchors the measurement. The difference between the cash advanced and the total future payments does not become instant income. It is earned over time as interest income. That is why this slide is important. Cash proceeds give us the starting point, and interest accretion explains the later movement. Now compare that with a non-cash exchange. If the note is received for property, goods, or services, we no longer have a clean cash price to anchor the note. The accounting answer is to record the note at the present value of the promised future payments, using a rate that reflects the credit risk and terms at the creation date. This prevents overstatement. A 3-year promise to pay is not automatically worth its face amount today, especially if the rate is weak. Present value brings the receivable back to economic reality. Interest imputation is the boundary with ASC 835. If the note has no stated interest or the stated rate is clearly below market, we cannot pretend the face amount is the economic value. The entity substitutes a reasonable market rate based on the debtor's credit quality, collateral, and term. That market rate discounts the promised payments and creates a discount on the note. The discount is then recognized over time through interest income. This is not a punishment entry. It is simply time value of money being reported properly. Fees and rebates create timing issues. Delinquency fees are recognized when the fee is chargeable and collectibility is reasonably assured. Prepayment fees are recognized when the borrower actually prepays, because that is the event that earns the fee. Rebates on prepayment are different. They reduce the economics of the receivable and are treated as an adjustment to interest income, not as some random separate expense. The key idea is timing discipline. Income should appear when the triggering event occurs, not when management wishes the event would occur. Classification is where management intent becomes very important. If the entity intends to hold the receivable for the foreseeable future or until maturity or payoff, the receivable follows an amortized cost basis model. If management has decided to sell the receivable, then the held for sale model applies, usually the lower of amortized cost basis or fair value. One caution: intent determines the current model, but it is not frozen forever. If intent changes later, the reclassification rules must be applied carefully, as we will see shortly. For receivables not held for sale, amortized cost basis is more than the unpaid principal balance. Start with outstanding principal, reduce it for write offs, adjust it for deferred fees and costs, and adjust it for premiums or discounts using the effective interest method. Credit losses are also important, but their model is not inside ASC 310-10. Expected credit losses are handled under ASC 326. So think of this slide as a layered carrying amount. Principal is the base, but not the full story. Held for sale receivables follow a different logic. If a non-mortgage loan is classified as held for sale, it is measured at the lower of amortized cost basis or fair value. If fair value is lower, a valuation allowance brings the carrying amount down, and changes in that allowance flow through net income. This valuation allowance is not the same thing as an ASC 326 credit loss allowance. One reflects sale classification and fair value pressure, the other reflects expected credit losses. Similar looking reductions, different accounting purposes. When a receivable moves between categories, the accounting needs a reset. We do not simply drag the old allowance into the new model and hope it behaves. The slide shows the right discipline. Reverse the relevant existing allowance, transfer the receivable at amortized cost basis, and then reassess and record the appropriate measurement under the new classification. This avoids double counting and keeps each category clean. In practice, reclassification is where messy accounting can enter quietly, so the reset sequence matters. Let us apply the present value idea. An entity sells equipment and receives a 3-year note. The note states 2% interest, but a market rate for similar credit risk and term is 8%. No cash changes hands at closing. This is exactly the type of case where face amount can mislead us. The note should be measured at the present value of future payments using the 8% market rate. The gap between face amount and present value is a discount, and that discount accretes into interest income over the note's life. Let us close the lesson with the 6 memory anchors. First, recognize the cash claim when the entity has an enforceable right. Second, use cash proceeds for cash exchanges and present value for non-cash exchanges. Third, impute interest when the stated rate is not market based. Fourth, classify based on management intent. Fifth, use ASC 326 for expected credit losses, not ASC 310-10. And next we move into ASC 310-20, origination fees, direct loan costs, and effective yield. If this helped you, please like, share, subscribe, support the channel, and share it with your colleagues.